I'm very pleased to welcome to Monetary Matters Harley Bassman, managing partner at Simplify and the Convexity Maven. Harley is known all around the world as an expert not just in interest rates, but in interest rate volatility products. And like everyone has a macro view, but Harley is knows how to actually put it into a trade. So I'm delighted to welcome Harley to Monetary Matters. Harley, so good to see you. How are you doing? And as we record a week after the Federal Reserve did its 50 basis point cut, how are you thinking about interest rates and the term structure? What are the opportunities that you see?
Well, great to be back. Thank you very much. You know, I, I, I was wrong. I didn't think the Fed was going to go and cut rates until after the election. I thought they wanted to keep their fingers out of the pie. But, is what it is. I do think that I think the back end of the curve is cooked. I think it's kind of done. I think we know what the Fed's plan is. It kind of laid it out for us with words and with dots. And unless you think that rates, unless you foresee a 1% funds rate in the near future, the back end's kind of cooked, and you want to go and you want to sell vol. You want to sell interest rate vol. You want to do it via either mortgages, current coupon mortgages, or callable agency, callable muni bonds. Both those work because interest rate vol is still way too high versus what it's delivering.
Okay, so the front end, the Federal Reserve, as you said, they have their dot plot projecting interest rates to go as low as 2.9% in the longer run or in 2027, and the short-term, the Fed funds futures are projecting that by 2026 about 2.8%. But when it comes to the longer-term interest rates, you think those are too high? And when you say cooked, I presume you mean that they are interest rates are too low, on the 10-year and the 30-year, and that they're going to go higher. So you expect prices to go down and their yields to go up. How do you express that trade?
I am not bearish per se. I am kind of neutral. That I think the ability for longer term, so called 10-year rates on out, to go lower is very limited. Can they go? Should they go higher? Yes. Will they go higher? Yes, I think so. But they're not going to blow back to 5 and change percent. I mean, they'll go back to 4.5, maybe 4.5. Why do I think this? Just old man rules, old wives' tales. They want inflation of 2%. Will they get it? I think not, but let's just assume that's what they want. And then Fed funds to the 2-year, usually 50 basis points. That's kind of why they have like a 265 dots. They changed it to 285, which I'm kind of curious why, but I guess things have moved. But nonetheless, they're talking, let's call it 275. That's what they're kind of thinking about for Fed funds. Fed funds to the 2 years, what, usually 50 basis points. And then 2s to 10s is maybe 75. I mean, when you add that together, that puts the 10, about 4.25, somewhere in there. We're 380 right now. Like, where are we going to go? I mean, to get the back end down, you need you need to think the funds rate's going to 1, which is possible. Sure, I just don't think it's going to happen. But I mean, for the curve to be where it is right now, requires a belief that there's a possibility of a large downside move in rates, and then you have some hedge value for owning long duration securities. I tend to think the reason why the curve is still inverted, which it is, and there's 2 ways of looking at the curve. One is the actual cash treasury curve. And if you look at that right now, 2s, 10s is plus 17. The more interesting thing for me, all the Wall Street geeks, is we look at LIBOR or now SOFR, the derivatives curve. That's where all the hedging is done, all the modeling is done, all the trading is done, really, in the derivatives market. And that's still -9, which we can talk about why that's important in a second. But I just don't see how there's a whole lot more movement here. And therefore, if you look at the big investment, concept in rates trading, not equity, not commodities, okay, rates trading, you have duration, you have credit, you have convexity. Duration is when you get it back, so a 2-year or a 30-year. Credit's if you get it back, so I'm going to buy Apple or Carvana bonds. And the convexity is how you get it back. Of those 3 right now, convexity is the richest, I guess that's the highest number, the best value, because the curve's inverted, so you're not paid money to take more duration risk, unless, of course, you think We're going to crash. IG's at 52. That's nearest tights. That sounds kind of crazy. The move right now is at 92, which is down a lot from where it was. It was trading 120, 140 last year, but it's now at 92. The realized move, so of the components of the move, it's trading at 65 right now. So the realized volatility is a 65 basis point normal volatility. What that means, 65 basis points, what that means is a 68% chance of being plus or minus 65 basis points a year from now. So when we talk normal vol, normal distribution, everything you learn in stack classes, all you need to know here, that's 40%. So the implied vol is 40% above the realized vol. That is extraordinarily high. For most liquid instruments, you're going to see 1 month options trade an implied vol 8 to 12% above realized. So right now, the realized vol of the S&P is 14 and change, and the VIX is 15 and change. So about 8% higher. Boom, boom, there you go. The move's the wrong price right now relative to what it's doing. And when that, so doing trades that sell that embedded optionality, that's the risk you want to go and overweight right now, is things where you're selling optionality, selling convexity in the interest rate market. So that your callable bonds, mortgages, munis, callable agencies, all those bonds should do better, over the reasonable term.
So you said IG is at 52. I mean, investment grade credit spreads are at 52 basis points, 0.52%, meaning it's quite rich. Investors are not being that paid much to take that marginal amount of credit risk. And the MOVE index is a implied volatility index for the Treasury market. The MOVE is to the Treasury market what the VIX is to the S&P 500, and you are the creator of the MOVE index. So you said that implied volatility, as measured by the MOVE index, is too high, and realized volatility is way lower than that. So I asked you earlier, are you bearish on the Treasury market because you said it was cooked, and you said I'm not so much bearish on it. Could we interpret that you don't want, rather than buying puts on it, you'd be much more inclined to sell calls?
I'll sell like straddles, actually.
Okay.
That's what I'd sell both sides of it, or strangles, I suppose. I think we're in a reasonable range. I think it's hard for 10s to get below 350 unless the Fed's just taking that rate down. It's going to be hard to get above 450 probably. So you're probably in that range over there. And if we're going to stay in I just described a 50 basis point range, right? The move is implying a 92 basis point range. So factor, that's why I think that's where I want to go and sell. That's where I want to go and take more risk. You're always going to have some duration, some credit, some convexity. You're always going to have that. It's a matter of when do you over or underweight versus the index. And so what I'm proposing is the notion of selling down some credit and buying some more current coupon mortgage bonds. That is the portfolio structure I would be suggesting right now, with my belief in the world as it is.
And you and Simplify have a product that is new coupon mortgage bonds. Why did you create this product? And tell us, how have you judged its performance? I believe you launched it in early November, which is pretty close to the top in rates. How would you judge how it has performed, and how do you attribute the various performance of it did well because interest rates went down, which benefited all long duration products, versus it did well because the mortgage spread narrowed, which is what you're focusing on?
So yeah, we bought the product last November. It now has almost 1.4 billion. It's totally organic, but there's no seed investor. And what we do is we buy the newly issued mortgage bonds. They have coupons of 5.5%, right in there. This is versus the almost every other mortgage product you will see in the market, which is buying the mortgage index. The mortgage index has like a 3.25 coupon, because it's 70% bonds with 2 to 3.5% coupons that were all created, 3 and 4 years ago during QE. Let's be clear, that was a public policy good, allowing people to go refinance their 4, 5, 6, 7, 8% mortgages down to 3%. That's a good deal. But the owners of these mortgage bonds, not so much, because basically they own low coupon, high duration securities. The product we created owns bonds near par. What that means is two things. It's going to have a much higher distribution. So I'm going to be kicking out, 5.5%, 6% coupon as opposed to a 3.25%, 3.5% coupon. Higher yield to maturity when you map it all out of about 80 basis points. Much higher yield than corporate bonds. So right now, mortgage bonds yield about 115 basis points over treasuries, corporate bonds 52. So you're going a lot up in yield, yet you are have no credit risk. I mean, Fannie and Freddie are not going bankrupt. If you think there's a risk of that, you should be buying guns, gold, and cans of tuna. And don't forget the can opener. It's just not going to happen, okay? If you buy the mortgage index, you're going to get a duration of like 7, because these bonds aren't going to prepay. Newly issued mortgage bonds can prepay, and so this ETF we have has had a duration of 3.5 in there. Rates have rallied tremendously since November, so of course having a 7 DV01 7 duration is going to move more than a 3.5 4 duration. So of course rates that product has done better nominally. However, on a risk-adjusted basis, our product has done vastly better. So if you were to go and buy our product plus some like TLT, just to bring back the overall duration of the portfolio, that package would have outperformed the mortgage index. You've seen vols come down from 130, 140 to 90. You've seen the curve go from inverted to kind of flattish right now. So if you back out the duration impact of the market, this portfolio has done vastly better than mortgage bonds that are based upon the index. And I still don't want the index at all. I mean, it offers no value to me. What is a mortgage bond? A mortgage bond is basically a buy right. That's all it is. Because we know when the homeowner takes out a loan that pays us $3,000 a month, a chunk of that goes to interest and a chunk goes to principal because it's an amortizing. It goes away in 30 years. We know what the cash flow is going to be from the principal coming back. We don't know how long that interest payment is going to be coming for. Whether it's going to be 2 months or 30 years. What we've done is you've given a call option to the homeowner who can prepay or call this bond back at any time for free, no penalty. If you're going to do a buy right, and so if you were to model up a mortgage bond, it looks like buying a 10-year treasury and then selling a 3-year covered call against it. So maybe you buy the mortgage, you buy the treasury at par, you sell a $105 price call option against it. What creates the value add is, are you selling that call for 4 points, 6 points, 8 points, 2 points? That's what we try to figure out with our computers. And what's happened in the last year is we've gone from that option being worth 8 points to now being worth 6 points. And because vols have come down, the curve steepened or become less inverted. What I'm proposing to you is that option is going to go from 6 points to 4 points over the next 6-9 months as vols come down more and the curve steepens more. When you own a 3% bond, that option is worth $1. It can't go down by that much more. It's kind of silly to actually do a covered call and take in only $1. You should be taking in a lot more money than that, or you shouldn't be doing it at all. Kind of like buying NVIDIA. Like, who would buy NVIDIA and then sell, like, it was taking like what, 120 right now? Like, Why would you sell a 200 strike call for $1? That's just stupid. I mean, if it is, it's going to go. It's going to go. You don't want to clip off the wings. If you think NVIDIA's made its move and it's done, then sign the 125, 130 call for 10 points. That's a good idea. You don't sell options for pennies. And when you buy the mortgage index, you're basically selling a call option for pennies. It's a bad idea.
And so your product with the ticker, which is MTBA, and other mortgage rate and most fixed income products will benefit as interest rates go down, and their prices will go down as interest rates rise. But what you're talking about is true regardless of where interest rates go, and there are other risks, investing risks, and that's why I'm glad you're here today. So Harley, I think of as your trade, new coupon mortgage-backed securities as kind of, I'm going to call it the anti-Silicon Valley Bank trade, because many people, including people on TV who should know this, talked about how Silicon Valley Bank owned all of these treasuries that were underwater, which actually is not really true. The vast majority of their holdings were agency mortgage-backed securities, which is what we're talking about. And they had coupons, that is yields, in the 2%, 3% range, which they bought when interest rates were at zero and when yields were incredibly low. So I'd love for you to just map through mechanically why the Silicon Valley Bank trade blew up, of just why did they lose those losses? Not only how those securities declined in value, but also how, because of duration, but also how the duration got worse and how that hinges on prepayment factors.
Two components here. Number one is, even if they hadn't bought a single mortgage bond, they bought 10-year treasuries, they were going to blow up, because what a bank does is they take money in at some overnight rate, but deposits. It's government guaranteed, so there's no risk. So people put their money in there. So maybe at the time they're taking in money and paying out 0.5%, but they're investing treasuries at 1.5%. So if they're making money, that's good. When the Fed started to take that rate up to 1, 2, 3, 4, 5%, they had two problems. One, their portfolio is only earning 1.5 or 2, and now they're paying out 5, so they're bleeding on a cash flow basis. And two, those bonds with 2% coupons go from trading at 100 to trading at 80. Just the nature of fixed income trading. Bond prices move inversely to interest rates. Mortgage bonds are, since they're negatively convex, they go down faster and up slower, but just ignore that. It doesn't even matter. The problem they had is they didn't hedge out that mismatch of having their deposits be overnight money and having their investments being 10-year money. And should they have known better? The answer is yes, they should have. The risk manager is clearly asleep at the switch. And why did this happen? Well, I'll tell you why it really happened. It rhymes very much with why we blew up in 06, 07, 08, is investors, risk managers, banks, they believed the Fed word for word. If you remember, the Fed dot plot was basically zero out to 2023. Okay, it was zero. And these guys said, okay, I got a year and a half, man, of zero. I got no problem at all. I'll hedge in 2023. The Fed then came and jammed rates up, and oops, that was a mistake. Should you believe that? Should you take the Fed at its word and trade exactly as its word? Of course not. If only because they've already told you they'll change their mind depending upon the facts. But that was a mistake they made. Is they really did not buy any insurance. That they should have done is they should have bought PIFIX. They should have done. But that was the mistake they made. And this happened in 06, 07 when Greenspan said, in 04, I'm taking rates up in a measured pace, which meant 25 basis points, 0.25%, every 6 weeks, from 1 and change up to a larger number. And when everyone heard this, they go, wow, it's only going up by 25 basis points. Well, I can sell the 28 basis point out of the money put and I'm safe. Well, everyone started going and taking on massive bets and massive leverage, betting that the Fed would do what they said. Of course, when things changed, they weren't ready for it. They were over levered, over their skis, and they got stopped out. You really need to go manage your risk independent of what the Fed is saying. You can look, that's an important data point, but you need to do your homework. And also, you just need core limits of what you do. Those banks needed to have risk limits. Merrill Lynch is a classic example. We had like 50 billion in capital and owned 45 billion of CDOs. Like, I don't care what they are. You don't own 45 billion of one thing when you only have 50 billion of capital. It's just foolishness. And that's why Merrill went down. The same reason.
And Merrill bought by Bank of America, which also owns a lot of long duration products. Interestingly, Harley, why is selling a 28 basis point put in 2005 so bad? Because did they end up hiking by more than 25?
It wasn't that per se. It gave them this feeling of confidence that there would not be a radical market move, and therefore it's kind of like you own a bakery made of wood and you buy fire insurance on it and it starts raining and you keep buying the insurance it keeps raining, you keep buying the insurance. I'm like, you know what? Who needs insurance? It's raining outside, so you stop buying your insurance. Well, unless you're Noah, it's probably going to stop raining at some point. And that's kind of what happened is people took off all their hedges. They took off all their very and they let their risk get too large. So when we did have an event, they were unprepared for it. That's really what happened there. Is they trusted the Fed too much that they could run things at a quiet, measured pace, and they got overexposed. And the same thing happened with SVB. They took off. How much of they? I think they had no hedges there. But yeah, I mean, when they had that duration being 7-8 duration out there, that was kind of unhedged for a bank where your funding is overnight money. That's kind of crazy town. Now, if they were taking in 5-year CDs at 0.5%, then okay, they're funding at 5 years and they're locking and then they're lending out 10 years. That's kind of okay, I suppose. But they had the whole thing on overnight money. It was checking accounts.
Right. And do you think that the bond market is pricing in for a recession? And what do you think that it ultimately is wrong? And divide that into the short end and the long end of the yield curve.
If you look at the dots versus the current Fed futures contracts, they both merge at 2 7/8, 3% out 3 years. Hallelujah. What the difference is that the market is pricing in like 100 basis points more of cuts next year than what the Fed has said they're going to go and do. Are they right? I think not, but they could be. They could be right. So the front end is kind of already pricing in a more aggressive Fed, not a panicked Fed, but a more aggressive Fed. The back end is more interesting to me because I'm not sure why it's here and where it's going to go to. Even if the market is right and funds are going to 3% next year as opposed to the year after that, fine, put funds at 3. We need. I mean, I think a 3.75 10 years is the wrong number relative to that. So either A, the back end of the curve is pricing in a very hard landing very soon. I think a contributor is more likely the Fed's heavy thumb on the scale. The Fed, I think, still owns a third of all the back end bonds, and the Treasury, Yellen, is dumping all the supply into the front end of the T-bill market. So there's massive supply in the front end, less supply in the back end, and the Fed owns a gargantuan component of that. So I would call that it's not QE, it's not QT, it's thumb on the scale kind of stuff. They haven't put a limit, like a hard limit on how high rates can go, like they did in the 40s. But I mean, it's kind of in that zip code, I don't buy that. I think the Fed's right. I don't think the rates go below 3 because I think the demographics and other components will keep inflation at at the 2-3 area, not much lower. I mean, to get the funds rate to 1, you need inflation at 0 or negative to get there. Like they're not putting the Fed's rate at 1% with inflation at 2.5 or 3. So the back end is very kind of misaligned as far as I'm concerned. And so that's why I want to go and sell like these interest rate strangles via owning mortgage bonds as a trade, as an investment, as an over allocation. It's not a trade. It's an over allocation. Mortgage market is the second biggest market out there. You have treasuries, you have mortgages, and you have corporate bonds. Okay, so you're always going to own some of the mortgage market no matter what you do, whether it's 10%, on index at 21%, over index at 30%. It's going to be somewhere. It'll never be 0. When you buy the ag, you're getting your 20-odd% of mortgage bonds. It's just embedded into the that structure. What I'm proposing now is you go above the index allocation in buying more mortgage bonds and fewer credit bonds.
And the ag is the Bloomberg bond fixed income aggregate, and you like the new coupons, the newer issued ones, and to just explain for the audience, it's because they have a greater exposure to convexity. Because if interest rates go down and they collapse, and we do have another zero interest rate phenomenon, then those bonds are going to refinance, and those will suffer more than the average mortgage bond. So you're willing to take that risk because you get paid higher. Is that roughly accurate?
Yes, I mean, there's no free lunch in the world, but you have to go always measure out risk versus return. And in the current situation, you are being overpaid. Right now, mortgage bonds are 115 over. Their long-term average is more like 70, 75. And it's been well below that at times. So, I mean, we're at least going to go to average, which is another 40 basis points on mortgage bonds. So we're talking, I mean, another point or so on these securities. And it'll be the near par newly issued mortgage bonds that go up in price, not the discount mortgage bonds. Because the discount mortgage bonds, the index bonds, the option value in there is already very small. It can't get much lower. You want to go sell the big, meaty option that's near the money right now. But yes, you're taking more. Let's be honest. You're taking more convexity risk. And if you think hard landing tomorrow, the rates are going down tomorrow hard. 10s are going from 3.75 to 2%. In the next 3 months. You don't want any mortgage bonds. Okay, you want to buy long-dated treasuries. So let's be clear about that. There is a belief here that we're going to stay in a range. That is the profile you're putting on.
So yeah, your trade is based that rates stay roughly in a range, and that their implied volatility goes down, and that so the range that is perceived by the market or priced in by the market also narrows. So let's walk through an environment where mortgage-backed securities don't do well, and particularly new issues don't do well. March or April 2020, when very long duration products do extremely well because interest rates go to zero and yields collapse. What happens though? Because as people refinance, they're paid out at a par. So it's not as if mortgage holders of MBS holders lose when rates go down. It's just that they don't gain as much as they might think what their interest rate exposure was, before interest rates collapse, right?
Look, man, it's a cover. As I said, it's a covered. Think of it as a covered call in bonds. So if you buy a bond at a Treasury at 100, and in my example, you sell the call option at 105, then the most you're going to make is 105, well, plus the call money you took on in. And at 105, you're done. Whereas a 10-year Treasury can go to 110, 120, 130. So you're not losing money, you're making less. And when you buy the mortgage index that's trading maybe right now at 90, okay, you're still short a 105 call. So it can go from 90 to 105. So you make 15 points, but you get a much, much lower yield for doing that. If you think of things in terms of as a bond covered call being bought in one single package, makes it much more, it should make it more clear to people, because I think people are very comfortable with a covered call concept. And clearly, covered call ETFs are gigantic in the market right now, and everyone knows what they do. You increase your income and reduce your upside, which is not bad per se. It's just a trade-off. I mean, option selling in general is converting capital gains into income over the horizon, which is not bad. It's just no bad bonds, just bad prices.
Do you think that the prices in the credit markets right now are bad prices when you have, as you said, investment grade credit spreads, 52 basis points, high yield credit spreads around 300 basis points, quite narrow in comparison to history? Is that accurately pricing in a chance of a recession, or that defaults will spike?
There is a massive disconnect between the Fed funds futures market and equities and credit. Because how does the Fed funds market think we're dropping by 150 basis points between now and December of next year, when the Fed has already said what they think it's going to be? The only way that happens is they think the Fed's going to cut rates really hard. They're only going to do that if bad things happen. If bad things happen, usually stocks go down, more bankruptcies, and credit spreads widen. So one of those two numbers is wrong, right? Is IG and junk bond yields the wrong price? Kind of yes. I mean, look, if you buy a high grade corporate bond at 50 basis points over treasuries and it doesn't default, hold it to maturity, who cares? On a mark to market basis, could it go against you? Yeah, sure. But you'll make your 50 cents. Should you have made more for the risk you're taking? The answer is yes. You should have made like 70 or 80 basis points. But, you're probably not going to lose your money if you do that. Now, junk bonds are different because they can actually default. I'm presuming that IGs can't default. They can just widen and spread. Junk bonds actually can default. And when they default, it's money gone. You can't get it back. So that's a different story entirely. Junk bonds at plus 307 right now, that is very, very tight. Is that a good idea? If you think we're for a soft landing and all's fine, 300 is still 300, man. You can't cry about that. But as a risk return, like if you're going to Vegas and making bets, that's a bad bet right now. Both those are bad bets in the scheme of the world. You're taking on credit risk at the lower end of the range when the Fed funds market is saying, "Hey guys, there could be a problem ahead. We think we are confident enough there's a problem ahead that we're going to go and buy these futures 100 pips lower than the dots." So there's enough ammo out there. People are buying these things for that reason.
Yeah, and Harley, the bond market, the Treasury market is pricing in a hard landing and one that is a vicious economic scenario. Does that worry you, and how do you weight that? How does that go into your weighting of your the odds that you assign to there being a recession? When I first heard about you, the first interview I saw, it was right before it was in 2019, and it was about the inverted yield curve, and you were getting a little bit cautious. And of course, we had the March 2020 panic. The yield curve had been inverted for over 2 years now. The Treasury curve uninverted. Interesting to hear you say that the SOFR curve, the swaps curve, remains somewhat inverted. When is the inverted yield curve an appropriate cause for panic or of concern? And if so, is it when the curve inverted 2 years ago, or is it now when it's uninverting?
One can make the case that when the curve inverted, we did have a little mini recession in 2021, 22. That we did have 2 quarters. It was never called a recession. We did have 2 back-to-back quarters of negative GDP. So maybe they called it and they were right. Now, does it count that it was COVID? I don't know. It's kind of like a Babe Ruth, Roger Maris kind of question over there. It was 2 quarters of negative GDP, and that usually is the definition. So maybe the curve was right, and we had the recession. Should we be scared of an inverted curve even right now? We're supposed to go look at why it is, and I think the hangover of QE is still there. That the Fed owns the back end of the market, and they're issuing on the front end, and also the fact that the Fed was very late to the party for a variety of reasons in hiking rates. So they kind of had to do catch up, and now they're 9% inflation number. That's fairly frightening after basically a decade of near zero. So I can see them being rattled by this. So I don't think we're having a hard landing. I don't. And I think we're having continued reasonable low inflation for, I guess, 2 big reasons. Basically, demographics. If you look at the 70s, the inflation there was not Johnson's guns and butter, right? The Great Society, spending Social Security, Medicare, and the Vietnam War. So it's guns and butter. I think this audience is probably pretty young over here. It was really labor force growth rate of the boomers entering into the economy in the 70s and hitting max production, getting married, having kids, buying a house, a baby carriage, a car, demanding goods from a smaller World War II generation. It was smaller in number because of lower births during the Depression, but also because they died in the war. More demand from boomers, less supply from the prior generation, up goes inflation, supply demand. What's happening right now is the millennials, who are numerically bigger than the boomers. There's more millennials than boomers, but it's on the boomers were big of a very small population. So as a percent, they were bigger. There's actually more millennials. They get married 4, 5, 6, 7 years later. And the average first baby in New York is 31 and San Fran is 32. That's much older than what it used to be. And when you saw the household formation of a decade ago, of everyone wringing their hands, of people trapped in the basement not playing video games. That was true, but what was happening is household formation was under trend because millennials got married later. But if you check it out now, Zoom, it's kind of caught back up to trend as they've gotten married and they're demanding goods and services, and they're demanding them from what? A smaller boomer class, because the boomers are retiring faster than trend. Why? Well, because stocks and bonds, housing is at an all-time high. The boomers have all the money. Sorry, we stole the money, millennials. I'm sorry.
Yeah.
But we took it all, and we're retiring early. And thus we're reducing these productive boomers. So we have a lower supply and greater demand. And thus, I think that's like a core, demand supply imbalance. And that's why you're going to see this underlying inflation that's going to maintain. So that's my story. You can believe or not believe. Mike Green, my partner, will tell you I'm crazy for a variety of reasons. But that's my view.
So we can put up this fantastic chart that you put in your research convexity Maven, which I rely upon and people should check out. We'll link to in the description. A chart from Ned Davis Research showing how household formation exploded in the 1980s and 1990s. From 2000 to 2015, it went down, but it actually has been going up, and it projects it to continue to go up until 2030. Would that world not be one in which interest rates, not only inflation is 2 to 4%, but why aren't you getting very, very concerned about that inflation will go up to the highs of 9% or even higher?
I don't think the mismatch between supply and demand will get as great, because the boomers were a vastly higher proportion of the economy back then. There's also, it's more productivity and other stuff out there, and we have more globalization, which maybe we're bringing back now. But I don't think it gets that high again. But I mean, it doesn't have to. I mean, all it's got to be is 2.3, and a 10-year 375 is the wrong number, right? I mean, you can buy long dated tips at what, 150, 175 right now. Like, why would you buy a 10-year at 375 with inflation at 3? You're getting a real of 75. I mean, as I said, there's a mismatch here in the long end, in the interest rate market versus other markets out there. Unclear how it's going to resolve. But I tend to believe in soft landing or no landing, and that you're going to see long end rates slowly rise back up again. Not go crazy, but slowly rise up there, and the curve will steepen as the Fed pulls their front end down to match that area. I mean, if we get inflation of 2.3, having funds at 2.5, 3 that's fine. That's fine.
And I understand why you think the 10-year won't go below 3.5%, but the top end of the range, I don't know if you said it was 4.5%. What is stopping yields from going above 4.5%, especially given that they were as high as 5% less than a year ago?
When they were going to 5% and the move is at 140, what we didn't know is, when was the Fed going to be done? The interesting chart that no one talks about anymore, but was for 6-9 months, the biggest chart everyone had, was the move versus the VIX. Mm-hmm. Everyone loved that. The two of them went in line for years and years and years, and all of a sudden the move explodes and the VIX doesn't. Why is that? Well, as I said, implied vol 8 to 12% over realized vol. The equity market didn't move that much. It went up, but it was an orderly, rise. And thus the VIX hugged it. We had massive 10 basis point moves every day for weeks. And thus the move went up to 140, 150, 160 for that reason. Because we didn't know when the Fed was going to be done. We just didn't know when inflation was going to hit the top and come on down. We're so used to this 2% number, and all of a sudden this takes off, that no one expected. Well, some of us expected, but the Fed didn't. That we didn't know what it was. And now that we know where the top is, or we think we know the top is, we have a boundary. And that's why everything's kind of stabilized over here. Could rates go back to 5-6%? Of course they could. Why not? Of course they can. I just don't think they will. I think we're going to kind of stabilize in a lower area. But is it possible? Yes. Should you buy an interest rate hedge that I happen to manage? Well, yeah. You should buy that. You should always have some kind of tail insurance somewhere. And it doesn't have to be buying options outright. It can be other ways of how you structure your portfolio to do this. But you should be, investing in commodities, in QIS, in gold, all these various things that you can do to go and diversify yourself, to go and reduce the volatility of your portfolio. Those are all fine ideas to do. It doesn't have to be just strictly buying S&P puts.
So Harley, every December you come out with stocking stuffer, which are not trade recommendations, but trades that you are thinking about doing. Last year was a very interesting one. And one of them was this new coupon, new issue mortgage-backed security thing that we have talked about. If you don't do stocking stuffers in September, but if you did, what else is on your horizon?
The two trades I like right now is one, this whole idea of new issue mortgage bonds. I think that's a no-brainer for any kind of reasonable investor to allocate money to. Don't put everything there, but you can easily have 10% of your money in that portfolio, and that would be a rational thing to do. The other trade, which none of you are going to go and do, but I'll tell you what I'm doing personally, is basically getting short the forward rates in the front end. So right now, the 3-year rate in derivatives is 3.25%, and the 1-year forward is 3%. So the market is still so inverted. I'm basically finding ways. In theory, you can go and short the Fed funds futures, like the greens or the blues out there. That's probably the range of the greens. So next year, the year after that, somewhere in there, because I think the futures market is way ahead of the Fed. That's a little risky, but that's maybe you do a put spread on that to make it a little less, scary. But I'm probably most confident that the front end market rates for next year are too low. They're 100 bips ahead of the Fed. I just don't buy that. So those are probably the two best trades I have out there. I don't mind buying callable muni bonds near par because I'm once again selling the option. I don't mind Federal Farm Bank credit callables. Because they're state and local tax free. So if you live in California or New York, you're saving 14% right there in your taxes. And they have very high coupons. Once again, they're callable. I mean, they could be a 6-month piece of paper or they could be a 20-year piece of paper. So you got to kind of get comfortable with that. But they issued some bonds a few months ago at 6%. State and local tax free. I kind of like that. Now, was that a 6-month bond or a 20-year bond? I don't know. But I was willing to own a 6% coupon on a U.S. agency that was not going to go down. I mean, Farm Credit Bank, once again, not going down. So I view that as a treasury. So I just keep kind of trying to get myself into places where I'm selling optionality on interest rates. Not the VIX. VIX at 15 ain't shorting that. Okay? And the VIX at 15 is really anomalous with the Fed funds futures being where they are. Like one of those two numbers is wrong.
If you had a hunch about which one was wrong, the VIX at 15 or the Fed funds so far above the 2-year, so far trading rich to the 2-year, which one would it be?
I think the December 2025 Fed funds contract is the wrong number. That's that, or maybe the September one. One of those two in there is the wrong number. Where it's basically 100 basis points ahead of the Fed. That's what I think, and I think that for a couple of reasons. I mean, one, I don't think inflation is going to 1, but number 2 is. Why do we still read like the great books, like the Greek tragedies, Shakespeare? What do these guys all kind of capture was that the great destroyer of mankind was always hubris, was ego. I mean, look at the current election we have going on here. Well, I guess the other old guy's gone, but that was an ego battle, man. That was insanity when 2 8-year-olds running for president. It's just ego. And it's always ego that gets you at the end. And Powell, he's made a lot of money, nice kids, nice family, probably a wonderful dog. Like, what's he doing this for? He's doing it for, public service, and he wants to go down as the guy that kind of managed, the U.S. economy through COVID and landed it. And he wants his tombstone to say, Paul Volcker's second son. He does not want to be Arthur Burns. Arthur Burns was the Fed chair during the 70s who took rates up, took rates down, the inflation came back and exploded, and the guy's a goat. Nobody wants to be Arthur Burns. So I tend to think that Powell is going to be really less aggressive than even the data might suggest, because he does not want to be Arthur Burns. He'd rather overshoot the other way, and as opposed to inflation snap on back on him and have that wrapped around his tombstone. I think Powell's ego is going to make it so he's going to be very careful before he gets that rate too low.
And so just to explain for the audience, so that trade that you like, that again is pretty somewhat advanced, is that it's the December 2025 Fed funds is pricing in a 2.9% rate by December 2025, and the dot plots from the Federal Reserve is a median projection of 3.4%. So you think that by 2025, the Fed will have cut closer to 3.4% than the market's overly ambitiously forecast or price of 2.9%.
Yep, maybe it's a SEP contract. It's one of those in there. I haven't looked exactly because I'm trading it in other ways than futures contracts. But yeah, that's the idea. Somewhere you can go look at that. They're listed futures contracts, for God's sakes. You can go look at them yourself and figure out. The dots are publicly available. It's a pretty easy trade to go figure out. But I would probably do a put spread on them as opposed to the shorting contracts, because if you're short the contract and we do get a hard landing, that could be a problem for you. So I would probably do a put spread on those as probably for retail, probably the best ticket I have.
Interesting. Harley, you are a bond guy, as people know. You have written occasionally in Stocking Stuffers about stocks that you like buying call options or call spreads on stock markets or on the European indices. What are you thinking about the stock market now? Any way to trade that? Any thoughts you have?
Most of what you're talking about, when I was writing 2, 3, 4 years ago, what was happening was that we had 0% rates in the US and negative rates in Europe. And therefore, when you traded futures or options or derivatives on these various vectors, foreign currencies, all those things, when people price derivatives, futures, forwards, options, all that stuff, it's priced upon the mathematical forward price, which I've written about extensively. What is the forward price? Forward price is simply the calculation of where you break even. So for grandma can buy a 1 year or a 2 year. The 1 year rate is 3%. The 4 year rate is 4%. 1 year rate's 3, 2 rate's 4. How do you make that decision? You'd only buy the 1 year at 3%. If you thought the 1 year rate a year from now would be 5% or more, 3 plus 5 equals 4. The forward rate was 5. It's a break-even example. Other way around, if the 1 year rate is 4 and the 2 year rate is 3, then the forward rate is 2, right? To get the when you have these negative rates in the market going way out, when you got involved in derivatives, you were locking in a borrowing cost of 0 to negative. And that gave you incredible opportunities to do stuff. Right now, with the Fed funds rate at 4 and change, there's really, I don't want to borrow at 4.75%, right? There's no advantage to being in derivatives when I'm basically locking in a borrowing cost that high. As a matter of fact, rates are expected to go down. So if anything, I'd be selling that kind of stuff in theory. You use derivatives as a way to lock in longer term financing. And so that's where those trades were very interesting. But right now, where rates are here, Europe, and everywhere else, except for Japan, there really is no advantage to borrowing long term in the derivatives market.
Got it. And so you're not thinking about stocks that much?
I think stocks are fine. If I was an ordinary civilian, I'd be dumping 60% into SPY, 40% into bonds, or maybe actually I'd probably do maybe 50% stocks and 30% bonds, and then I'd have other amounts of money in like commodities or some gold or things like that.
Right. But because you're not a civilian, although you are a civilian now, you've been in the game so long that you can never be a civilian again.
Yeah, I mean, look, long-term stocks are going higher, if only because they're based on a nominal price. And so if we have inflation of 2%, 3% every year forever, then a company's earnings will rise by 2% every year. We have a growing population. Maybe it's immigrants. I don't care. Take your pick on that. But we have a growing population and growing prices. Therefore, companies' earnings will go up over the course of time. And since stock prices are based upon earnings, if they're going up nominally, they will go up. Stock prices will always be trending higher. Now, can they go down and you are forced to liquidate for some personal reason? That's a bad idea. Yeah. Can you buy single name stocks and they can go bankrupt? Yeah, they can. But if you buy the index, you're very diversified. And if your horizon is up 20 years, like I tell my kids, just put your money into SPY and like some intermediate term IG index. Call me in 20 years. Unless you're a real pro, picking single names is really, really hard to do, and I don't think I'm qualified for that at all.
Why? So you liked call options when interest rates were zero or near zero because when you had very low rates, the forward price was much lower. And correct me if I'm wrong, call options benefit as interest rates rise, but interest rates are no longer rising, they're falling. So that makes you not attracted to call options anymore.
I'll give you a simple example. When the market closes today, go pull up your whatever screen you have, look at the futures contract for the S&P, and look at the closing price of the S&P. And you're going to see the futures price is higher by 10, 20, 30 points. Okay? Because of the rate differential. The borrow rate, the funding rate, is what, 4.75 now? And the dividend of the S&P is what, 1.5, 2? There you go. The forward price is simply those two numbers annualized, up, positive or negative. When you had a S&P dividend of 2.5 and a borrow rate of 0.5%, futures prices were lower. The reason why what people are looking at the put call, like all these strategies where you sell the call and buy the put, they're going, oh my God, like last year, I would sell a 5% call and I could buy 10% out of the money put for zero cost. And now you can do it almost even up. Oh my God, stock calls are rich or puts are cheap. No, it's just the forward price is going from being negative to positive. That's all that's happening here. The skew really hasn't changed that much. The prices of the options have changed, but that's because the underlying forward price has gone from a discount to a premium. You have to go back that out to get a real evaluation of skew. You can't look at skew as put price minus call price. That is not. Now, I mean, if you're, it's a good trade. It's a better ticket. If you're going to do a risk reversal, it's a better ticket now, clearly, and that's fine to do. And that strategy is fine to go and do. But it's just what you're doing implicitly when you do that is you're investing money now at 4.75%. That's not a bad trade right now. It's like, I mean, the Fed funds rate is still the highest yield on the planet, right?
And yeah, that confused me for a really long time, Harley. So I'm glad you're talking about it. I think a really clear example would be a high dividend stock like a real estate investment trust. I want to ask you about that later. But just is if it pays 10% and it's at $100, the forward price is going to be 90 in a year. So looking at your screen, and I don't have a Bloomberg terminal. A lot of people watching this don't have Bloomberg terminals. It's going to look as if the calls are cheaper than the puts, but actually it's not. It's just that the forward price is lower because it has a high dividend yield.
Yes. Well, as a matter of fact, the trade I showed 3 years ago was you could go and buy a 5-year call on the European Dow 50, the SX5E. You could buy a 5-year. So the index was trading at, I'll make up a number, 3,000. You could buy a call struck at 3,000 and sell a put struck at like 2,300 for zero cost, because the rate differential was so huge, because European rates were negative and the dividend yield was like 4.5%. So you take that 5% differential out 5 years, and then you put some implied vol skew, that's a pretty nifty trade. You could basically buy an at the money call, sell a 27% at the money put for zero cost for 5 years on the European market. And by the way, they have listed options in Europe. You could do this trade, forget derivatives, you could do that trade listed in Europe. That trade's gone now because it's the other way around. You now have the European borrow rate is above the dividend rate there. So, I mean, that's all it was a matter of borrowing at zero, borrowing at negative. That was the magic. And I just found a way to go and take that concept of borrowing at a negative rate and doing it in a trade form.
Thank you. Harley, you've written before about mortgage real estate investment trusts that are often levered forms, so they borrow money and invest in mortgage-backed securities, which we've been talking about. This environment that we have now, where the short-term rates are falling, you happen to be quite bullish on new issue agency mortgage-backed securities. So you happen to be relatively bullish on mortgages, but specifically new agencies. How does that shape your view of an asset class such as mortgage real estate investment trusts, where they borrow money to invest in MBS?
At this stage of the game, the REITs have the wind to their back, finally. All these REITs are is basically kind of my trade, leveraged 7, 8, 9, 10 to 1. That's what it is. The problem you have is when the curve is really inverted, you have the Fed funds rate, flat to above the mortgage rate, and that created problems. But with the front end coming down, and we're finally putting the funds rate below the mortgage rate. So right now, Fannie 5s are trading near par. So call that a 5% for the mortgage rate. Funds rate's what, 480? Okay, it's finally a positive spread. So having leverage on, you're going to make 20 basis points there times 7, plus the cost of the money. That's a winner. And if they keep pulling this front end down, if the front end comes down faster than the mortgage rate does, that spread's going to widen. Leverage 7, 8 to 1, that's a winner. So you're seeing a lot of the mortgage REITs now trading above their NAV in anticipation of further rate cuts. And so I have no problem with owning mortgage REITs right now. None at all. I own a number of them personally.
Very interesting. What else, I guess, in the interest rate universe haven't we talked about? We talked about a lot.
God, I mean, there's foreign currencies, but that's kind of boring.
Yeah.
Stocks are kind of boring. I mean, the bond market is interesting. It's bigger than the stock market, and people, it's never exciting because it's fun to talk about Nvidia. Like, who's going to talk about 10-year notes at a party? I think we've covered most of it. I'll just say that the general investment lesson I have for you is sizing is more important than entry level. You're never going to buy the bottom or sell the top. Just put that in your mind. It's not going to happen. You want to go invest enough. So if you're right, it makes a difference. If you're wrong, it doesn't wipe you out. So find an idea, put half the money in right now that you like. Don't try and time it. You can add to it if it goes down or vice versa. But really kind of look at your sizing within your portfolio, what you want to do. Don't get so excited you dump everything into it. But don't make it so small that it's kind of boring. I mean, if you're only going to invest pennies, like you're creating a line item and a tax headache. Don't do that.
That's really good advice. And I'll say something. I have happened to bottom tick something once, but I sized it so small that, it's fun to say, but it really didn't do anything for me. Whereas if there's a stock or an asset that you like, but you size it appropriately and you didn't catch the bottom, but you caught enough of it, that is way better. So I just want you to say that again, Harley, as you say it in all your notes.
Sizing is more important than entry level. I will say this. I actually did buy the bottom once, but this was when we were just converting over from voice brokers to electronic. I hit the wrong button. I was trying to sell. I hit the buy button by mistake. I bought the bottom.
There we go. Harley, I do want to ask you about sizing because Simplify does have a ETF. The ticker is TUA, where it's a levered 2-year fund. So basically, it has benefited as interest rates have fallen. But the massive move in the 2-year from May, the TUA is up 11%, which in the bond world is fantastic. But it just shows to me how I believe TUA is 5 times levered. If you want to make money trading 2-year notes, you have to be extremely levered. So just the importance of sizing.
Well, yeah. I mean, trading twos need a lot of leverage to make any money in that, but that's fine. I mean, to make 10% in a 2-year note is pretty nifty, I think. I actually I think more interesting now is we have the 2-year levered 5-to-1. We have the 7-year futures contract levered 3-to-1. That's probably the more interesting trade right now if if Fed really pulls rates down as advertised. So you can look at that because the 2-year levered 5-to-1 gives you a duration kind of close to the 10-year note, and the 7-year levered 3-to-1 is closer to the 20-year Treasury. So that's kind of how they're structured. They're both they both have had significant drag on them. They've not performed as well as you may have expected if you bought it a year ago, because the Fed it was a negative curve, and therefore the leverage was eating that negative carry. As the front end comes down and goes through the yield of these underlying securities, these things will perform much better than they have in the past. So once again, there's a timing issue here about it's not just where it's going to go, but how it's going to get there, how fast. And I think right now we kind of know what's happening. It's a matter of the speed of where it's going to go to. And that's really the argument. I think everyone agrees that the Fed's taking rates down. The discussion is it going to be, over the course of a year or over 3 years to get to that 3% number.
Right. And as you said earlier, it sounds like you're more interested in taking the opposite side of that trade of betting that the Federal Reserve won't, being bearish the 2-year note. I do have some questions on Twitter. Some guys asked, do you have any plans for your ETF MTBA to start taking delivery of TBA? I believe that stands for to be announced, in order to be able to harvest spec pools. I have no idea what that means. So can you please explain that for me and the audience and then answer it?
Okay. We got some Wall Street geek over there. Ordinary mortgage bonds, none of you have ever bought a real mortgage bond, okay? It is almost impossible to do. And 90% of all mortgage trading is done by TBA, to be announced. All that means is a 1-month mortgage futures contract. That's all it is. It's a 1-month futures contract. It's called a forward because it's not listed, but they're identical. That is most mortgage trading. There are people out there who think they're really clever, and they say, I'm going to take the actual mortgage bonds in, and I'm going to try and buy some Iowa mortgage bonds, so bonds that have a lot of Iowa in them, as opposed to California bonds, because the Iowa bonds prepay much slower than the California bonds do, and therefore they'll be less negatively convex. So there are people out there who will trade spec pools, specified pools, to try and buy pools that have a certain propensity to them. They don't want New York State because there's a mortgage tax there, things like that. We're talking really in the weeds. This is a very, very small market for real professionals. It will never happen to anyone who's listening to this conversation, except for the 5 spec pool guys on Wall Street.
Got it. So your ETF will not be doing that anytime soon. I've got a question now. In one of your Convexity Maven pieces, you basically had CPR, which I believe stands for conditional prepayment rate. It's the how much are mortgages prepaying when mortgage rates go down. People prepay their mortgages very high. I believe it peaked around 30 to 40% in the spring of 2020 when you had that huge shock where you had to refinance your mortgage because you were losing money if you didn't. And then very few people refinance when rates went up and when rates were above the median mortgage rate. Where do you think refinancings are going to be? And does that differ from, what any blue chip estimate of CPR is going to be?
When I quote the mortgage rate, I quote something called CMM, constant maturity mortgage. And what that is what is the yield of a mortgage bond trading at 100, exactly at par. Once a mortgage bond goes away from par, the yield is unknown, period. It's unknown. It's unknown because you don't know the prepayment speed. If you own a mortgage bond at 105, every time you get a prepay, you're getting back 100, but you owned it 105, losing 5 points. If you're going to get 10% of that back in a year or 20% back in a year, there's a very different yield because you're losing 5 points on 10% or 5 points on 20, right? If the bonds trade at 90 and you get a faster speed, you make money. So the yield goes up. No one knows the prepay speed. We've tried to model it and figure it out and guess. There's so many factors driving what causes that. So when I quote the mortgage yield, I'm quoting the exact par yield because that is the only time I know what the true yield of a mortgage bond is. When you look at the strategy that I have that invests in current coupon mortgage bonds, we have no prepays. We don't because it's always in these TBA market. And what we have done and have been doing is when we brought this thing out, rates were higher, we were buying Fannie 6s and Fannie 5.5s. What we've been doing as we've been getting money coming in, we've been buying Fannie 5s and Fannie 4.5s. The goal is to keep the average portfolio between 97 and 101. And right now we're near 100 right now. If rates went down a lot, I would be selling Fannie 5.5s and buying Fannie 4.5. So I'll always keep the portfolio near par. Now, that will also mean that the distribution comes down because I now own Fannie 5s as opposed to Fannie 6s. So you should not be surprised to see the coupon come down at some point in the reasonable future, depending upon a lot of different factors. But if rates stay down here, at some point I'll have to reduce the coupon of this thing, but that is as advertised because we're owning the cheapest, the mortgage, the bond near par is the I call it the best value. You're selling the biggest option in there. Theoretically, if rates went down by 200 basis points, my strategy would merge with the index. Because the index coupon now is a 3.25 coupon. If rates go down by 200, well, we'll have Fannie 3s, 3.5s as being near par, and my product will basically merge with the two. They'll be the same thing. Could that happen? Yeah, I suppose. But also, you'll be earning an extra 200 basis points from now until then, right? Because I have a higher yield. So depending on the speed, if this was to happen over the course of 3 years, you're better off owning my product. It happened overnight, a lower duration bond in my book, then you'd be better with the other product. So that's kind of how it goes over there. I mean, it's just like anything. If you were to cover call strategy, you buy the stock at par at 100, you sell the call at 105, you get to 104, you're not called, you then sell a new call at 110, it goes to 109. If it happens very slowly, a covered call, that is the ideal covered call strategy. You sell a call, you get right to strike, but don't get there. Option expires at 0. You do it again a little higher than that. Where you get hurt in a covered call strategy is when the market moves a lot either way. That's how you get hurt. So it's a timing issue. And as I said, with the current structure of the yield curve, it'd be hard pressed for me to see the 10-year, 30-year rates move a lot quickly.
Thank you for that, Harley. So there is a perception, I'm curious if you agree with this, that the American economy and the structure of the debt structure was not very sensitive to interest rate hikes. In other words, when the Fed raised interest rates from 0 to 5.5%, there was a sense that the people would go insolvent and they would refinance. But the reality is that corporations and the households had borrowed out very long-term debt, mortgages, what we've been talking about, and Apple and all these firms had borrowed out in longer term, 5-year, 10-year, 30-year, as long as 40 or even 50 years debt. So the people who got screwed by higher interest rates was not so much the borrower, but the lenders so far. So my question for you, Harley, number one, do you agree with that? And number two, as interest rates fall, do you think that that the economy will be similarly interest rate insensitive, and that, if going from 0 to 5.5 didn't cause a recession, going from 5.5 to 3 won't be super stimulative as some may estimate right now?
I think the answer is yes to all your questions. Okay. Albert Edwards at SocGen has a nifty chart, which I'm not sure he did or he borrowed it, that shows net interest payments for corporate America. They're actually earning money now. They borrowed so much money so far out, they took it in cash, and it's now earning 5 as opposed to 0. The corporate America is actually earning money on their debt, which is utterly insane, but they are. you had, I don't know, most of the housing market refinance. I mean, 70% of the market is still Fannie 2s to 3.5s. So higher rates has not impacted homeowners at all, has not impacted people who own houses at all. Your lower income people who don't own houses and have credit card debt, well, that's a problem because their rate's gone from 12 to 20. So yeah, they're sad for sure. I do not think you've seen an increase in rates be restrictive because, I mean, what do we have? Real GDP of 2 and change, 3 and change. I mean, we're not restrictive in rate right now at all. So if we bring rates down, will that be stimulative? Probably not, or not like it used to be. So I think you have a much lower, beta coefficient of rate to economy now. But at the margin, obviously, it works. And yeah, the losers, who were the losers when rates went up? It was the banks who lent money at a fixed rate and US government, right? I mean, you've seen the Fed used to give X billion dollars every year. They're now, posting losses to the Treasury, which of course doesn't matter because they have infinite credit. But I mean, theoretically, if there was a bank, it'd be bankrupt right now.
And so Harley, you did say that you don't think that the current interest rate, previously 5.5%, now 5%, is restrictive. The Federal Reserve definitely does. So I just want to make it clear that you don't think that interest rates are restrictive right now. In other words, if the Fed didn't cut at all, you don't think there would be a recession.
The Fed didn't say it's restrictive, really. What they said was inflation's here. We want to recalibrate to be 50 or so over inflation. That's where they want to be, a real rate of like 50, 75 cents. That's what they want. If inflation's coming in at 2.5, then being at 3 is the right number. I'm not sure they actually said it's restrictive. Maybe they're worried a little bit, but no. We have nominal GDP at 6. For God's sakes, man. I mean, there's a theory for us, you Chicago geeks, that the 10-year rate should have some relationship to nominal GDP, where nominal GDP is the income statement of the country, and the 10-year rate is the cost of capital. There should be a small spread there, but they should follow each other. They shouldn't get way out of line. Otherwise, people over borrow, right? If nominal GDP is 8, you can borrow at 2. You're going to borrow everything you can and build a factory or whatever. And similarly, if cost of capital is 5 and the economy is at 2, well, you're not going to be borrowing any money, so demand goes down. It's hard for me to see. We have a 6% nominal GDP for 10-year rates to be much below 4%. It all kind of lines up. Now, once again, this relies upon, inflation of 2.3 and real GDP of 2.3 to go get your 5.6 nominal. You could make the story that we're going to hard land and they'll both go down. That's a fine story, and I can't say you're wrong. I just disagree with it.
Right, and so I see why you say that the 10-year looks low because nominal GDP is at 6% and the 10-year is below 4%. Of course, on the short end, interest rates are at 5% and inflation is 2.8%. 3-month annualized, it's lower. Curious, some people measure it in different ways. But Harley, we will leave it there. Thank you so much for coming on Monetary Matters, being one of my first guests. I'm really honored that it was you. People can find you on Twitter at ConvexityMaven, your writings at convexitymaven.com, and people should check out the work that you do with Simplify. Thank you so much for coming on, and thank you everyone for watching.
Thank you.